Hi everyone, this is Demel Gonzalez of Heartwood Financial Services. Welcome to another edition of the Market Update for the month of May. Well, I hope everybody's summer is starting off with a bang. The Gonzalez family here, we started off with quite a bang. Our oldest son, Andrew, just graduated from high school. So I am a very proud papa. So again, thank you for joining. If you have any questions, please reach out, let me know. Always happy to chat. All right, to get things kick-started, we're going to start with the asset class returns as of the end of May. So what we could see here for the large cap stocks, we had a decent 1 month performance up 0.7. I changed the chart a little bit to show the year-to-date numbers. So up 12.62 year-to-date is pretty darn good. Small caps outperformed quite nicely, up over 2% for the month, over 23% for the year-to-date. Real estate up 1.21%, again a pretty strong showing, and almost 20% year to date. Developed market was the winner for last month. Ironic, we were talking about that last month on the last presentation. Up 3.35% for the month of May, but lagging for the year. So maybe there's a little change going on there. We will see. And again, I'll talk a little bit more about that. Emerging markets up 1.53% and up 7.42% for the year. But again, a better showing, better than twice than what the S&P 500 did. And then bonds were up a little bit. They're still a little bit negative for the year, but they were up a little bit, and so was high yield, up 0.21. And interestingly, as you can see, when bond yields or when bond returns are positive, it tends to also be good for gold. Gold had a really good, and outside of stocks in general, gold was actually up the most for the month, up 7.46, but barely breaking even for the year. So pretty interesting. This is kind of a continuation of what happened last month, and we'll talk a little bit more about expectations for the summer. So the market update title is "What Could Go Wrong?" Everything has been going great. The news is great. The economic figures are really encouraging. I always like to see that there's something to worry about for the stock market to continue to climb higher. It's called climbing the wall of worry. And when there's not a lot of worry, that actually gets me worried. So obviously I'm going to be a little cautious, but I'd like to highlight some of the events for May. And so here are a few, and I'm going to go through them real quick, and I'll get more into them in the next piece. COVID-19 numbers keep dropping. The rest of the world is finally catching up. The FactSet consensus for 61% second quarter earnings for the S&P 500. This is huge. This is the highest since back in 2009 in the last quarter. So pretty impressive. The AAII, which is the American Association of Individual Investors, they have a sentiment that they use that is really, really high right now. And I look at that sentiment indicator as kind of a contrarian one. So when they're really bullish, that makes me get a little concerned. And the jobs numbers just came out this morning, and they looked really, really good. It's all relative. They were very good, but when we're down 20-something million jobs and we're trying to gain them back, of course, the numbers are going to be looking very good as we reopen the economy. But it is moving back in the right direction, and I think it could improve dramatically more come September. Okay, for the Outlook piece of the presentation, titled it Summer Slowdown. Where is it, right? Um, and so I'll talk a little bit about where I'm coming from there. But first of all, I'd like to point out Vanguard is looking at inflation probably peaking in Q2 of 2021. And then this whole summer slowdown, one of the things that I'm looking at is the S&P 500 and how much its 50-day moving average is above its 200-day moving average. This is something that I track, and it's right now above 10%. Frankly, it's the highest I've ever seen it, and I've been tracking this for about 10 years now. So we'll talk a little bit more about that. And of course, I am expecting some sort of pause or correction. And so it may not be very big, but it probably makes sense for something in the 5 to 10% range sometime over the summer. Again, I might be wrong. This is just kind of where I'm seeing things. And so I'm going out there and cashing in some chips from some of the gains that we've seen, and I've been continuing to add a little bit to the international, which has better valuations and starting to catch up from an economic standpoint. All right, summertime is pretty much here, and I'm sure I'm not the only one that's going to be taking some summer trips. And so when you take a summer trip, one of the things you almost always have to do is rent a car. Now, what I'm talking about here is renting a car in the States. If you travel internationally, this is a whole other ballgame. So this is traveling in the States. And when you walk up to that car rental counter, it's always, this type of conflict where do you buy the rental car insurance? So is it a good buy or is it a goodbye? So it depends. All right. And so I'm going to give you the quick reasons why you need it and what you need to do to check to make sure you're covered. So first of all, your car could get stolen or damaged, right? And so you need to call your auto insurance company, make sure you got the comprehensive and the collision, and it gets covered through to your rental as well. And usually it does. You could damage someone else's vehicle or property or injure someone. So in that case, you need to have the liability coverage, and usually that is covered in a rental as well if you have that on your auto policy. You could get hurt in the car. Well, that is usually covered by your auto insurance as well. There's a medical provision there. So just double check, make sure they cover that. And then belongings that could be stolen. Well, in that scenario, it's actually your homeowner's insurance that typically covers that. So that's a good thing to just double check with your homeowners because usually your auto insurance won't cover that. Now there are some other considerations, and I learned something in checking this out. There's a policy, or there's a provision that the rental companies will charge you what's called the loss of use. Okay, so if they're fixing the car because it's damaged and it takes them a week or 2 weeks to fix, they're going to charge you the amount that they would earn, for not having that car, or they would lose for not having that car in use. And so when I called my auto insurance company, it turns out that they don't cover that. So what I did is I called the credit card company that I was using, and I specifically asked them this, and it took about 2 or 3 people to finally figure out that yes, that is covered through the particular credit card that I was planning to use on that rental car. So great. So now I have the loss of use covered as well as all the other items that we mentioned here. So I could say goodbye. And the last thing, I always like to leave you with a little inspirational note. I know there's been a lot of things to worry about, a lot of negativity out there, a lot of bad news that comes from watching politics, social media. It can get very frustrating. And some of us tend to kind of focus on these negative things It's something about our human nature, I guess. But what I wanted to do was just read you one of my favorite quotes from Philippians 4, verse 8. Finally, brothers, whatever is true, whatever is honorable, whatever is fair, whatever is pure, whatever is acceptable, whatever is commendable, if there is anything of excellence and if there's anything of praiseworthy, keep thinking about these things. Fill your mind with the positive things, not the negative things. Believe me, the negative things will still be there regardless, and it will probably make you a much happier person. All right? So thanks a lot for listening, guys. God bless you until we meet again. So real quick, I'll go through the COVID numbers. You guys have seen this chart many times, but I'll focus right here on the cases and see how they're going down dramatically. The hospitalizations are way down, the deaths are way down. And we're starting to see this happen internationally as well. They have been lagging, especially some of the countries like India and Brazil, but they seem to be starting to get things under control. Now, there's still things that can go wrong. There's still those variants that are out there, and I know the healthcare community is going to continue to bring that up. I guess there's always going to be some sort of variant. I don't know if that's ever going to truly go away, but the point is it doesn't seem to be affecting the vaccinated populations, and as we vaccinate more and more people, you can see here that we're up to almost 170 million people in the United States that have been vaccinated. That's about 50% of America. And that doesn't even include the people that have already gotten sick and probably have some sort of natural immunity. So we're definitely on the much, much better end of this pandemic. So you heard me talk about the FactSet Numbers. This is a company that does all kinds of analytical financial figuring, and there was a Insight article that highlighted how Q2 of 2021 is going to be the biggest earnings growth for the S&P 500 since back in 2009. And you can see right here, this is the S&P 500, 61%, and it keeps going up. And you can see how these other industries, particularly the industrials, financials, are actually going to be a lot higher than that, which is pretty impressive. So for the year, we're still looking at about 32%. And I don't know if you remember from last month when I was playing around with the numbers and how things are valued. We are priced in, I feel, for about 40-something% earnings growth. So if we get 32% earnings growth, which is what FactSet has as the whole year number, we could still see that would be a little bit of a disappointment based on how the market is priced right now. So that's why I'm saying, there could be some things that don't go perfectly here that can kind of have the market take a little pause. And I mentioned that AAII survey. I'll show you here real quick off their website. You can see how right now they're at 44% bullish and 19.8% bearish. Normally they're at about 38% bullish and 30% bearish. So once it starts getting to plus 20 more bullish than bearish, I start getting a little concerned, because historically that's been a sign that maybe the average investor is getting a little too excited, a little too optimistic. Oftentimes that's a setup for a letdown. And then the last piece for the market update, you could see that the jobs numbers have been very good over the last several months. Again, we lost that big 20 million right when we started shutting everything down last year. with the pandemic. We've had some great numbers right off the bat. They've been starting to go down a little bit, but you could see this month for May was a nice little uptick improvement from April. And my thoughts on this is as the pandemic relief for unemployment starts to wear off, a lot of states are actually cutting them short early because the time frame is September for the federal government to stop paying those out. And so some states are actually doing it ahead of time. I heard there's up to already 20-something states that are doing it before the September deadline. And of course, all of them will probably do it by September, of course. So you could see probably these numbers are going to continue to improve, and I think that will actually be very good for the economy. It will probably help with some of the inflation because people are going to start making stuff again, producing things again, and the short supply of things will hopefully be alleviated a little bit, meet the demand that's been out there. So in the outlook, I talked about how inflation could be peaking in Q2 according to Vanguard. This is the chart they had on their insight paper when they were talking about this. And here's where we're looking at the CPI, which is a basic inflation measurement. And you can see how it went down here during the pandemic. And then as we come back, what they're expecting is for things to peak around 3% for the CPI right around the middle of the summer in the July time frame, and then it kind of settles down. We'll see if they're right. There's still some factors. I think the demand is going to be maybe a little stronger than they think. Getting things back up and running might take a little longer than they think, so it might get a little out of hand, maybe a little bit worse than the 2.9, but the consensus is mostly for things to peak sometime this year and then to start to settle back down again. And as you can see, the numbers are nothing like they were back in the 70s when we had double-digit inflation numbers. All right, so you heard me talking about the moving averages for the S&P 500 and how that's one of the things I'm looking at just as another indicator, and I do tend to look at some of the technicals just to get a second opinion on things. And you could see here that when the 50-day moving average of the S&P 500 is much higher than the 200-day moving average, and in this case it's more than 10% difference. I haven't seen that in a very long time, and I've been tracking this little indicator for well over 10 years now, is whenever it gets that high in the past. Now this is just a 3-year chart because I didn't want to get it too busy, but you could see how whenever that happens here, this happened right around last year when the market took a big hit. Over here you have at the end of 2018, and over here right at the beginning of 2018. Those were times when you saw little drops, and so anytime that 50-day moving average gets substantially above the 200-day moving average, it's just a little bit of a warning sign. Now, it doesn't mean it's going to work every single time, but it is another opinion that, this might be, market might be a little high. So in the outlook summary, I mentioned cashing in some chips and taking a look at adding more to international. That is actually in the works as we speak. Doing that, rebalancing, cashing in some chips. And this slide here might look familiar. It's the same one I used last month, and that's because we will be adding to some international exposure. You could see how the earnings look really strong for international. You can see Europe, Japan, and in China, but especially emerging markets look really, really strong. And the valuations pretty close to their average or below their average, in a lot of these markets as opposed to the United States. I've shown you already several different reasons why I think that it's starting to get a little expensive. So I'm starting to shift a little bit more this way along with cashing in some chips. Thanks.